Hi, this is Tony Hansen, and I want to thank you for joining me again today for my presentation, Advanced Pivot Timing Techniques. In today's class, I'm going to share with you some market timing strategies that I use to help time pivot trades. This is a presentation where even if you're a newbie trader, you're going to be able to master the strategies that I'm going to share with you using the power of Fibonacci. Before we get too far though, take a second to read over this disclaimer in terms of use. Trading always comes with some risk. So be aware of what those risks are right from the beginning, and there's less of a chance that they're going to catch you off guard. In my last video, Unleash Your Winning Trades Using the Power of Fibonacci, I shared with you several techniques that I use to help with timing market reversals, even things such as where I'm placing my target levels and how I can get more out of my trades using Fibonacci ratios. In today's class, I'm going to start with just a little bit of a review of that material because we're going to be expanding upon that throughout today's session. One of the first strategies that I shared with you in video 1 was how to use Fibonacci to improve your entry price points using Fibonacci retracements. These are levels such as the negative 38.2% level, negative 23.6% level, and of course, the most popular one is going to be that 38.2% retracement. Instead of going back and showing you the examples that we already reviewed though, I'm going to show you some new ones using these same techniques. So the first one is using retracement entry timing with Fibonacci. And this is a trade that I had in Apple where initially I had been on the long side coming off of this low. And we'll actually get into this strategy further in the second half of today's video. But I had rode Apple up to this 23.6% Fibonacci retracement level, and at that point I looked to time a reversal. So I watched for a two-wave development with momentum shifting back into that 23.6% Fibonacci retracement level to initiate a short primarily on the shorter term intraday timeframes. But that Fibonacci retracement level was one of those big bonus points that helped secure that trade as a winner. The next technique that we looked at was how to build your target timing confidence using Fibonacci extension levels. One example is shown here, and this is the Aussie dollar for those of you that trade Forex. And it is a continuation strategy that took place whereby we had an initial strong move off of lows on June 11th, followed by a three-wave corrective move into the morning of June 13th, and then a breakout for a continuation move on the upside. The first price point that served as resistance was the 61.8% Fibonacci extension level. This is a really common zone where you will often see an initial pause take place on any type of continuation type of move. Now with that typical pullback for a continuation type of breakout, my target generally is the 100% extension level. However, sometimes things can impact what level ends up holding, and we're going to basically spend the rest of today's class looking at some of those extenuating circumstances and how to determine which levels are going to be stronger than others, particularly with one specific type of strategy. In this example though, it gives a good indication of how the 61.8% extension level can serve as some initial resistance, and then we see a continuation move that takes it into that 100% extension level before we see a larger correction once again take place. The third market timing technique that we looked at in our last video was using Fibonacci clusters to help basically build confidence in different support and resistance levels for that market timing. Now the chart that I've pulled up here is once again the Aussie dollar, and it is that move that we were looking at in the previous slide, but it's going to show you how those clusters come together. I have a lot of different types of Fibonacci actions shown on this chart, and in fact, if you're doing your own trading, it might seem a little too cluttered. However, I wanted to show you how some of those levels really do come together and provide that extra level of confidence for support and resistance levels. So, for example, we have the initial rally here off of the lows. When we look at corrective type of moves, you'll notice that this pullback here into the morning of the 13th is coming into several types of Fibonacci support. So we're dealing with basically 4 levels of Fibonacci support based upon these previous moves that took place. Now this gave a continuation move, and we can see it coming into that 61.8% extension level. At that level, notice that you're again seeing a cluster of these Fibonacci levels coming into play. And this is where we're also seeing things such as a Fibonacci fan take place, and furthermore, a Fibonacci arc, which is serving as resistance, where we are seeing that third cluster develop that is at that absolute high. So these additional types of Fibonacci are basically providing even greater confidence in those levels as resistance than we saw on the previous slide, where we were just looking at the Fibonacci extension levels. So we have 3 levels of Fibonacci clusters. The first one is that pullback level, which helps with the market timing for an entry strategy. We have the second cluster taking place at that 61.8% extension level right here. And then we have that third cluster taking place right at that pivot high. So it's helping time that reversal, or if you're long, this is where you need to be taking your profits. That red line there is another type of Fibonacci level, and it is called a Fibonacci fan. Here again we have an additional level called a Fibonacci arc, and both of these are 61.8% levels. So we are seeing once again the 61.8% serve as a very strong type of Fibonacci resistance. If you're interested in learning more about utilizing these arcs and these fans, then make sure that after you finish watching today's video, you sign up on the right-hand side of the video page for more information. Now we're going to get into the heart of today's presentation, and that is how to use Fibonacci levels for timing market pivot points. The first thing we have to keep in mind, though, is that you need to go beyond pure Fibonacci. You can put a number of different Fibonacci levels on your charts, and you will see some of those levels hold incredibly well, while at other times they will just blow right through those Fibonacci levels. The reasons behind why some of these levels hold better than others is very important for understanding what your reward potential is on a trade and whether or not it's even worth taking in the first place. Today we're going to look at 2 particular factors that will impact the strength of a Fibonacci retracement or extension level. The first one is going to be based upon momentum. Now, momentum or pace is basically how a price changes over time compared to previous price action. So it's a very simple concept, but it's often overlooked by traders. And a strategy that we're going to look at here in a little bit focuses very, very strongly upon momentum. The main concepts to keep in mind when you're looking at momentum are how these moves relate to each other. So when we're looking at B, you'll notice that that rally is stronger than this pullback here marked A. When you have a stronger than average upside move, you're typically going to see a slower corrective move take place. So when you're looking at support levels for that correction, the 23.6 and the 38.2% Fibonacci retracement levels are going to be the main support levels that will help hold and lead to a continuation move. You also have a better chance of getting a stronger continuation move where you're not only going to see that 61.8% Fibonacci extension hold, but you can get those larger extensions to the 100% extension level and even 123.6 or the 138.2% extension levels before you see a larger correction once again occur. Now, when the momentum shifts, that can lead to a stronger pullback. So from D to F, you have basically what would be the equivalent of the 100% extension followed by an extension to around the 138.2% extension. And then you're seeing a larger corrective move take place. With this shift in momentum, that larger corrective move has a better chance of going through some of the closer support levels, such as the 38.2% extension, and going and pushing to a retracement of 50% or even that 61.8% Fibonacci extension. As momentum continues to shift, you're going to see it have a more difficult time pushing through to those greater extension levels. With this correction, your retracement from this correction has a good chance, even as it hits a new high, of hitting that 138.2% retracement level. However, as an extension level from the previous upside moves, let's say from the beginning of D here to the high of E, and then this pullback, and once again to the upside, it's going to have a harder time trying to get to that 100% extension. Instead, you're going to see the retracement levels hold more easily, and the extension levels are going to hit those closer levels of extension. So when you're looking at adding Fibonacci clusters, you would be looking at, for example, on this move up here, you could see a Fibonacci retracement level of 138.2 following this pullback, but it might only be a 61.8% Fibonacci extension level when you're looking at it compared to the previous upswing. As momentum continues to shift, you'll continue to see that interaction take place, where a stronger bounce can lead to a little bit of a larger corrective move, such as the 50% correction. And as the momentum shifts, those levels such as the 23.6 and the 38.2% become stronger levels once again. If we go back to that previous example, what you'll notice here is that when we were looking at the extension move on the Aussie dollar, we had an upswing here where the overall momentum is about the same as the move heading into the correction. So we see a pretty strong follow through to begin with, and that impacts how the resistance levels are going to hold. Since this upswing here compared to here has about the same momentum, it increases the chances that it's going to go and do that larger 100% extension, and the 61.8% extension is going to serve as just merely a brief resting stop along the way before it goes and hits that larger target level. It is very important to realize, however, that this 100% extension level is very closely tied to the previous upswing prior to the corrective move. If this move on the upside were more gradual, there would be a better chance that you would see that 61.8% level hold as opposed to seeing the 100% level hold. If we go and look at Apple, what you'll see is basically the same type of idea. In this example, though, we had a move lower that was followed by an upside momentum move that was really similar to this last move at the beginning of April heading into those lows, basically forming a V at the lows. When a V forms, that previous level where that V began serves as a very strong resistance level. So you're basically looking at approximately the 100% retracement coming off of this low from this drop is going to serve as a resistance point. Now, in looking at the overall trend here, that point also corresponds to the 23.6% retracement level. And at this point, we see momentum shift. It holds that resistance level, has a little bit of a stronger move as it pulls off of that resistance level, and then has a more gradual move as it goes back and retraces into that resistance level. So when I was looking at this as a short strategy, what caught my eye was not only the major resistance that was hitting here, but also the shift in momentum that was taking place as it was hitting that resistance level. That told me that I had the potential of getting follow through on the downside where the momentum could be as strong as that initial move off of the resistance was in the first place. So as it retraced into that 23.6% the second time with the slower momentum, I utilized that zone to place a short based on a smaller intraday time frame. And I treated it more as an intraday type of trade, just a shorter term swing trade using the 90-minute charts, but basing it upon the resistance that was taking place on the larger daily time frame. Here's another example of how momentum comes into play when you're looking at target zones in particular. In this example, we had a reversal that took place in the S&P 500. And this was a trade that I was looking on the short side and looking for a continuation move for this period of congestion here, for a continuation move on the downside coming out of that congestion, and basically doing a larger two-wave correction on the larger time frame. What we had happening here, however, is that as this first initially broke out of this channel, the momentum was a bit slower in B compared to A. The result was that instead of going and immediately hitting that 100% extension level, we saw it pause at that 61.8% extension instead. And at that point, it did a little bit of a pullback, a little bit of a correction before it continued the move. Interestingly, the momentum over here is what allowed for that continuation, because at this point we had seen stronger upside, but then the momentum began to shift as it made slightly higher highs, and it continued to shift as it came back and retested that zone right in here. So this rounding off at the highs helped this. Once it pulled back into the 61.8% extension, to do a little bit of correction and then do a second move to continue that extension into the 100% extension level. And you'll notice that even though this pushed a little bit through that 100% level, the exact price of that 100% level, it did so only after shifting momentum at that price point. So when you're looking at a target level, that 100% point becomes that target level, but depending on how the momentum is going into that target, you might see it push through it by a little bit farther before it ends up reversing. There's another way that you can measure that extension as well that can often give you a little bit of a more accurate price point. But instead of just using that first drop and then the extension or continuation move and looking for the 100% there, when you have a break out of a trading channel and it forms a two-wave move for the continuation, you can look at that first drop and then look at the extension from that level to give you additional levels of support. So you can see once again the 61.8% stalled the move before it led to a continuation into that 100% extension level. Again, that 100% extension level hit with some pretty strong momentum, so it reacted to that level with a bit of a slowdown in the selling instead of an immediate reversal off of that low. The second concept that I want to share with you guys when we go looking beyond Fibonacci has to do with mastering trend development. I've touched on this a little bit in the previous examples where we looked at, 2 waves, 3 waves over the last 2 videos. But in this section, I want to share with you basically my take on how to look at trends. Most of you are probably familiar with the concept of Elliott Wave, looking at the 5-wave trend development. But we're going to take this a little bit further and do things a little bit differently. But it's going to be pretty easy, I think, for you guys to still follow along. When I first began trading, I didn't really know anything about Elliott Wave. I did my own technical analysis. I kind of taught myself how to read the markets. So it was several years down the road before I was even introduced to Elliott Wave. And that was because I was talking with another trader, and they said to me, Tony, you're looking at Elliott Wave there. I'm like, what is Elliott Wave? I might have heard the name here or there, but I never really knew what it was. So you're going to see some similarities here when I look at trend development. But I hope to clarify things that make this concept seem a little less foreign to you. And basically, the idea behind it is that trends tend to move in pretty predictable manners. There's a little bit of quirks that you have to pay attention to, though, in order to understand what those predictable manners are. So we're going to look at a core type of trend development to begin with, and then we're going to take things a little bit farther and look at one particular type of trend. For those of you that are familiar with Elliott Wave, this template here that I've pulled up is going to look pretty familiar. But I've labeled things just a little bit differently. See, when I'm looking at waves of action taking place in the market, the key concept that you want to take away is that the market tends to move in waves of 2 or 3. So you'll often see those types of pairing take place. And as we're looking at a core textbook sort of uptrend, for example, your 3 waves of upside are what you would typically expect before you would be looking for a larger correction to take place. So in Elliott Wave, these would be labeled as wave 1, 2, 3, 4, 5, with intermediate corrective waves lasting typically 2 waves into support before you see the secondary push to the upside, which would correspond to wave 3 in Elliott Wave theory. Now, there are differences, though, in terms of how these corrective moves can take place and whether or not you're really going to see 3 waves holding, or if you see 4 or more, or only 2 waves on the upside before a larger correction takes place. How the trend develops has a lot to do not only with momentum, what is the momentum of each of these waves, but also how long the corrective period is that takes place between those waves as well. So when you're looking at wave 1 on the upside, if you have a correction that is lasting about 30 minutes, let's say it's a 2-wave correction lasting about 30 minutes, and then you see a continuation for wave 2. If you have a second 2-wave correction lasting about another 30 minutes, that adds better confirmation that you're going to get another strong continuation move for wave 3. If it corrects again for another 30 minutes, however, let's just say this is another 2-wave correction for 30 minutes, at that point you already have 1, 2, 3 corrections lasting approximately the same time, and there's less of a chance that you're going to get a decent continuation of that move. Even when you get a reversal strategy off of support, it's usually going to be a lot more moderate for a move on the upside. So if you're looking at extension levels, for example, this would be a case where if you're taking a trade off of support here following the 3rd wave of upside, you might still take the trade, especially if it's something that's forming on a daily time frame, but your extension levels that give you the target zones are going to be those closer extension levels, like the 38.2 or possibly the 61.8, just depending on what this momentum is as it reverses off of this high. but it's going to be much more difficult to get those extension levels of the 100% extension or greater coming off of that move. So momentum plays a really, really big role in how these trends develop. And I'll show you here one example. Again, we're going to go and switch and look at Apple here. And I'm actually going to pull up a chart this time to show you what it looks like. So here's a trend that developed in Apple. And it has the core 3 waves of upside that took place. As it paused, however, following that third leg of upside, you'll notice that even when it attempted to do an additional continuation move, that additional continuation basically just served as a trap. It wasn't able to do that solid continuation to get another strong fourth run out of it. If you look at applying the Fibonacci levels, such as these Fibonacci extension levels, you'll notice that the first time around, your 100% Fibonacci extension works incredibly well. And one of the things I want to share with you is, why did I do my Fibonacci levels where I did? Why didn't I start this here for an extension and instead used this point here? And that has to do with the fact that this is the last low that takes place within this period of congestion. We have a period of congestion here that is basically an inverse head and shoulders with the pull lower here, your shoulder, head, pull higher, right shoulder, and then breakout. So with a continuation pattern based on an inverse head and shoulders, or a head and shoulders pattern if this chart were flipped upside down, I will use that extension point from that right shoulder. If, however, it was just a 2-wave correction and then broke to the upside without that additional pause from a shoulder, I would use the low from that second low to give me my price extension levels. So that's why we are using this point here as opposed to this point here. Now we go and look at the next move, and you're going to see that same 100% zone holds very well. In this case, the momentum is very strong as it's coming into that 100% level. So we do see it basically continue to shift momentum as it comes into that zone. You can see that that zone is serving as the resistance point though, because a lot of this trading that immediately follows that level is basically hugging that 100% extension point. So this gives us those 3 waves of upside that we were originally looking at for the trend development. If we try this a third time, however, and we try an extension level at that point, once again, here is the left shoulder, here's your head, and then here's your right shoulder with the breakout coming from that shoulder. Basically a little 2-wave continuation with the shoulder, just like we saw a little 2-wave continuation on the downside. The same thing repeated over here with the little 2 waves and then a little 2-wave here. So, nice continuation move that if this pattern had taken place lower in the trend, we would have seen the potential for a great continuation move. But because it took place as this trend was extended, whereby we already had 2 levels of comparable corrective type of moves before continuations took place, this third time around it's not able to get going. So it holds that 38.2% extension level instead as a closer extension price point, and basically gives you a 2-wave pull higher, resulting in exhaustion that is serving to trap a lot of people because it's hitting that slightly higher high compared to the previous high, but it doesn't have that trend placement to really support that larger breakout or the larger continuation. And that's where you're ending up with this turning around and creating a reversal strategy instead. Now I know you haven't forgotten. I know that I promised you that we would be looking at some advanced pivot techniques, and that is exactly what we're going to be getting into now. So I'm going to share with you one of my favorite strategies for timing pivots in the market, whether you are a Forex trader, a stock trader, futures, doesn't matter. We're going to look at this particular strategy and we're going to incorporate the concepts of trend development and momentum, combining it with Fibonacci levels for timing these market pivots. This is a very specific strategy, but is also one of my favorite strategies, and you're going to see why very quickly, because it is something that repeats so often in the market that it's hard for a day to go by without finding an example of this type of trade developing. And I call this trade a momentum reversal. And the reason I call it a momentum reversal has to do with the momentum that is developing as this strategy develops. What I'm looking at initially is a strong move, something where you have a move in the market, no matter which market you're focusing on, that is preferably stronger than average, whether it's an upside move or a downside move. And many times that move will be a two-wave move. So you will see one leg up, a little pause take place, and then a continuation move. Remember, I told you that trends like to develop in waves of 2 and 3. Well, a two-wave move doesn't necessarily have to be a corrective type of move in terms of a pullback. It can also be an extension move, and that's something that gets overlooked quite a lot. Here is a strategy where we're looking at it as a two-wave extension move, and we're looking at the three-wave trend as the corrective move. In this case, that three-wave trend move changes the momentum of the trend, where we are seeing a stronger move pushing to new highs. And then if you connect the highs and connect the lows, you're dealing with something falling into a parallelogram, where the momentum on that parallelogram, if you transect that parallelogram, shows a rather substantial shift in the momentum. Now, this strategy develops when you have a series of three highs and two lows within this shift in momentum. You can, of course, flip this over and take it as a reversal strategy off of lows as well, but we're just going to look at it as a reversal off of highs. Fibonacci comes into play when you're looking at the extension point past the original high. Now, Fibonacci comes and plays a role in this strategy when you are using it as a retracement level. Even though we are looking at a price extension above this original first high, we're looking at a retracement of this overall larger upswing. The ideal strategy for a short takes place when this third high is coming off of that negative 38.2% Fibonacci retracement level. There are going to be exceptions to this. Sometimes you're going to find it coming into the 61.8%, for example, but that increases the risk on the trade. It makes it less likely that you're going to see as strong of a reversal, and it could just pause and lead into a longer correction. There are exceptions though, so keep that in mind. But those Fibonacci retracement points are incredibly important in your timing. So even when you have something that the retracement goes to the negative 61.8% level as opposed to the negative 38.2% level, you really want that high to correspond incredibly well with that retracement point. That is a key feature in this trade. And additional strengths are going to be a parallelogram as it goes into that high, as opposed to, say, a rising wedge or triangle. You prefer to see it form a parallelogram. Sometimes you'll see it look like a megaphone where it opens up, but that's not the ideal strategy. The ideal strategy is the parallelogram with a series of slightly higher highs, and the momentum within this parallelogram will ideally be comparable on each of the moves to the upside as compared to the downside. So basically you're dealing with a series of V's and inverted V's. Sometimes you'll see that momentum switch at the end where you'll see a little bit of a slower move up, and that can kind of create sort of a halfway point between this momentum reversal strategy and what could instead end up being a head and shoulders strategy. But for the momentum reversal with the Fibonacci trigger, we're going to be looking at those series of slightly higher highs taking place. And that third high is the key point to taking the reversal trade. And the entry trigger takes place when this channel going into that third high breaks lower. And again, you want that third high to be testing that retracement level, as well as preferably the upper end of that trading channel. Additionally, we have some trend development that comes into play where, when we were looking at that uptrend in Apple, we looked at how much time there was between each of those waves of upside. That same thing applies here. So these corrective moves, if you're looking at this V, the distance between each of these highs is going to ideally be fairly similar. So if the distance between your first high and the second high is about 30 minutes, you want the distance between the second high and that third high, where it comes into that Fibonacci retracement level, to also be right around 30 minutes. If you have all of these things lining up, you have a strategy that is going to hit this point right here, that first low basically coming off of the first high. It's going to retrace to that point around 80% of the time, sometimes even higher if you have, additional trend development on the larger time frame in your favor as well. But this is one of my favorite strategies because with just a couple of key things in line that you can very easily check off. It's either there or it's not. You either have these V's forming or you don't. You either have that similar distance between these highs or you don't. And you either have that upper end of the parallelogram at a Fibonacci retracement level, namely the 38.2%, but sometimes the 61.8%, or you don't. And if you don't, your risk is higher. But if you have all of those things, and many times it is very easy to have all of those things, then you're looking at 80% odds or higher that you're going to at least hit this zone from that first low after the momentum shift. And typically, depending on how wide this trading channel is going into that third high, that 80% point is going to be hitting twice what your risk is 80% of the time. If this is narrower and you have a tighter channel, you can get a tighter break. You could have a return where you're getting 3-4 times or more what you are risking, but the 80% is for twice what you are risking or more. So if you're risking $100 on a trade, 80% of the time, with each of those factors in play, you're going to be looking at this level as a target point and you're going to see it hold. So an incredibly strong pivot trading strategy that, like I said, it happens a lot. To prove that point, let's go to the charts. First, we're going to go back and look at this Apple trade. I mentioned earlier that an initial trade that I had on this was coming off of this lows, and it was based upon this momentum reversal type of strategy. We began with a move lower that had that little pause right here, and then the three nearly equal spaced lows. In this case, there was a little bit of a variation here because the spacing here, originally when I was looking to buy it, I was looking for a buy a little bit earlier in April. But it's spaced out a little bit farther where we saw an equal move into the lower end of the channel that put the spacing a little bit farther apart. And what you're going to see is that affects this level of resistance in here. But let me show you how the technique is played out with adding these retracement lines. So going into this move, the first thing you wanted to see is a level where you have that little bit of a pause halfway on the downside, and notice how well it pulls right into that negative 38.2% retracement level. So here's that negative 38.2% retracement level. And when we look at this rally that takes place off of that lows, my target zone was right around 460, 465 level, and it had to do with 2 points. Now, in this case, that channel break, as we were coming off of the first high, the channel break is right around that level as well. And we also had that 23.6% retracement level hitting at the same time as this previous high level. So this is one of those cases where you're looking at a strategy that's going to give you easily more than twice of what you're risking. But in this case, it doesn't quite hit that 38.2% retracement. It comes a little bit short of it. But given that the entry trigger was down here, you're looking at a reversal that triggered about 4 times what you were risking, if not a little bit more, just depending on how you were able to manipulate it using an intraday strategy as well, coming off of this equal move zone into lows. Now, I actually happened to wait until you see this little bit of a wider green bar here to do my entry, even though I was seeing strategies developing a couple of days earlier. But the reason for that had to do with earnings that came out that morning. So I wanted to wait until after earnings before I entered the trade. So this shows that strategy, though, where we were looking at it coming off of the lows with that larger momentum reversal. And then we can see how that retracement level also helped with market timing because it corresponded to other additional levels of resistance as well. Here's another strategy that developed, and in this case we're going back to Forex, and we're going back and looking at the dollar Danish Krone here, and this has another variation of this same technique where here's our move higher into right where that momentum starts to shift. Around this 50% level, you can see we had a 2-wave continuation move that took place. It was a little bit tilted, but it's still the 2-wave continuation. Has that 100% extension level here, and that's where we see the momentum begin to shift. Notice again, this shift brings it up into that negative 38.2% retracement. It attempted a little bit of a resistance at the negative 23.6%, but with this particular strategy, that negative 38.2 tends to be a little bit of a better level to look for. There's a little bit of a variation here in this strategy because we do see 3 lows instead of 2 lows, and that gives us basically the equivalent of 4 highs as opposed to those 3 highs. So a little bit of a variation here, but it's close enough to the template that it's coming right into that major resistance, a lot of additional resistance from previous price levels, and we are seeing that momentum shift take place. So it's a great place to look to time a reversal strategy to go on the short side. And once again, that 23.6% retracement helps serve as a support level for this strategy, which in this case is also right near that target zone from where the momentum began to shift. So in both of these examples, you're seeing the reversal take place off of that negative 38.2% retracement level, and you're seeing it hit that 23.6 retracement level as it moves back lower. So the key move that you're looking for is that move from the negative 38.2 to the 23.6 in most of the examples, which makes it really easy to have an idea not only where your entry trigger is going to take place, but also where your exit trigger is going to take place. So you can create a bracket order and manage the trade a lot easier that way. And it becomes a very technical trade that helps eliminate a lot of the emotions that you might have that can keep you from holding to those larger target levels. The more often you see this play out, in this very close to textbook manner with just a little bit of variation, the more confidence you're going to have behind it, and the easier it's going to be to hold for those levels the next time around. Notice another thing, as this comes off of this negative 38.2% retracement, that it is also, once again, that upper channel point. So even though we have 4 highs here instead of 3, you have the additional resistance level helping trigger the reversal with the channel resistance as well as that Fibonacci resistance. As this retraces, this is actually developing the potential for another pattern heading back in the opposite way, where we have a 2-wave pullback. If we look at extension, there was a 2-wave correction here. 1 wave, 2 waves. Hit the 100% extension level, and that point is exactly where we see the momentum shifting once again. Now when we add the retracement lines for this action here, this drop here though, we begin at the top and pull it down with the 2 main waves of downside, where your 50% point with the congestion is right through the middle. Here you have those larger retracement levels on the downside. The negative 23.6, that zone is already starting to hit, but there's still a ways to go before it would hit that negative 38.2%. So what would happen is, if this tried to trigger a reversal off of support earlier, before it hits that negative 38.2% retracement, you're dealing with something that could be a higher risk strategy. It could maybe just retrace to a closer retracement level on a smaller time frame, but it's going to have a more difficult time really giving you a larger momentum reversal for a larger retracement. On the other hand, if you see this widen up and develop those 3 lows on the larger daily time frame, and that comes into that negative 38.2% level, that's going to help trigger a stronger reversal off of support. That'll also help this adjust to the fact that this drop here was actually stronger than the initial pullback off of lows heading into April. So that'll help shift that momentum further and create a stronger reversal off of this support zone. We're just a little bit too early to see how well that's going to play out. In this same currency pair, if we just scroll back a little bit, you're going to see a couple of other examples of this same type of action playing out. So here's another one that took place where you have that upswing, the little pause, and then the secondary move. So if I go and draw the retracement lines based upon that move, here's what it looks like. So here is that negative 38.2% extension level. You see it's right into the upper end of that channel with the parallelogram. Our V is not quite there with the second move, so we're getting a little bit of a stronger push into that third high, but it comes right into that retracement point. This reverses, hits that 23.6% retracement level, but that first low corresponds more closely to the 38.2%. So we see it pull into that level and hold there a little bit better. And it continues and pulls back into the 76.4 a little bit later on. You continue to see even how these levels play out over time, even after this move has reversed and is continued on to new highs. These retracement levels are still serving as resistance points and support points on the move back up. But coming off of this high, pretty close to that same textbook look that we were looking for, creates that pullback to the 23.6%, which is sort of your, closer to your kind of 80% guarantee level. And that also leads then to the 38.2% here that is serving for larger support where the momentum shift is taking place. A little bit later on, you can see again these levels are holding pretty well as we continue past, but we have another example here where we have that drop that has that little pause in between. Right here, 50%, that's where that pause is taking place. And then here's our 3 lows, right into the negative 38.2% level again. bounces off of that level, hits the 23.6 for an initial little stall, and then goes into that 38.2%. So again, you have an 80% type of trade when these characteristics are in play. Now, even when you have a little bit of slight variation, such as we don't have the V, a clear-cut V here, heading into the first high and then the second low, it kind of has a little bit of an M shape to it, which equals out that inverted V. If you cut the pivot points of that M in half, that creates a little bit of a better feel for the V. We don't have the parallelogram because we actually have more of a megaphone type of look here, but nevertheless, it still hits those first target levels. So this is why, like I said, this is why this is one of my favorite strategies, because even with slight variations and not quite picture perfect strategies, just the core concepts and the core ideas are still going to give you those target levels that are going to hold for those first target levels. Now, there's always going to be cases where you can actually get more than these initial target levels, but that's that point where you're going to get that trade that's hitting at least twice what you're risking 80% of the time. To learn even more on how I apply Fibonacci to my trading and some of the advanced techniques I use, such as the strategy that I shared with you today, you can learn more by entering your email address and your name on the right-hand side of the web page where this video is hosted. And that will give you an inside look for my Fibonacci Mastery course. I am limiting the number of people that I'm going to be accepting into this course. But if you want that first look, I'd like to encourage you to sign up for the list over there. And you'll be hearing from me shortly, as well as Norm. And thank you again for letting me into your home, your office, sharing with you some of the techniques that I absolutely love. I look forward to any feedback you guys might have to offer me on today's video, or any other information that you would love to hear me share in the future. Thanks again, and have a wonderful remainder of your day.